What is the difference between universal life insurance and whole life insurance? My name is Carmen.
And my name is Darius.
And we are the founders of Wealth Nation.
When it comes to universal life insurance and whole life insurance, they both fall into the category of permanent life insurance, which means they insure you for your entire life. And that's up to the age of 100. From the time you insure to the age of 100, you're insured with these permanent insurance policies. Now, let me just focus a bit on whole life insurance. Every time you pay your premium with the whole life insurance policy, there's a savings mechanism that builds up in your policy. What that's called is cash value. The cash value you're able to borrow or withdraw at your convenience as long as money is available inside your insurance policy, and those funds are guaranteed. The next thing I want to focus on is the fact that there are a ton of riders that you can add to your whole life insurance policy. But we like to focus on just three because of what the concept that we teach of infinite banking. And what those three are is chronic illness rider, terminal illness rider, and additional cash value rider. Chronic illness rider, in the event that you get some type of chronic illness while you're insured, the insurance company will provide some of that death benefit to you for your expenses. And that's the same thing when it comes to a terminal illness. If while you are insured, you get a terminal illness, the insurance company will provide some of those funds to you for your expenses. Now, the last thing, which is our favorite, which is the formula of how infinite banking works, is the additional cash value rider. Now, the additional cash value rider allows you to put additional funds into your cash value so that they can be available inside your policy and help grow the cash value. Now, lastly, we want to talk about the death benefit. The death benefit of your insurance policy is guaranteed. Now, coupled with the cash value growing inside your policy and the guaranteed rate of return on there per your contract, your cash value is growing and your death benefit is growing in your policy. And those are guaranteed. Now, guaranteed is something that I really want you to focus on throughout this video, is because it's in the contract per the insurance company.
And I'll compare universal. So universal life, like Darius said, is a form of permanent life insurance where from the time you're insured, it will insure you up to 100 or 121 years, whatever the case may be. Mm-hmm. The next piece of that is cash value. There is cash value that grows inside a universal policy. But let me back up just a little bit. A universal policy was created because the public demanded more flexibility when it came to their insurance products. Mm-hmm. So they wanted to be able to have flexibility in the premium payments. So there are minimums and there are maximums that you can contribute to keep the contract valid that you can pay on an annual basis. Mm-hmm. So people like the flexibility of having the premiums different based off of whatever financial needs that they need at the time.
Yeah, and just let me stop you there because that reminded me of something that I didn't talk about with whole life insurance. Sure. Is the fact that your premiums are level. If you pay, let's say, $4,000 a year in your base premium, you're going to pay $4,000 for the rest of your life.
Yeah. And
that's what it is. It's consistent.
Mm-hmm.
So it's able to provide you a consistent rate of return also.
Yeah. Great point as far as the comparison.
So
whole life is steady, consistent, whereas mm-hmm. universal is flexible. It's up and down. It's whatever you decide. Mm-hmm. But what people don't realize with flexibility, on the surface, flexibility feels good, right? Because you have the ability to pick and choose however you want. But the flexibility affects the growth of the cash value mm-hmm. that grows inside your policy. Whereas whole life, since it's a level or not changing premium, when you have a flexible premium rate within a universal life, that affects the cash value. Mm-hmm. So not only are you paying for the premium in universal life, you also have to contribute additional funds to the cash value to keep the cash value flowing. Mm-hmm. Because if you're turning your premiums on and off, that's affecting the cash value, and the universal policy relies heavily on the cash value to fund the premium if you need it.
Key.
If that makes sense. So I know it's kind of a lot to take in, but the main thing that I want you all to understand from Universal Life is it provides flexibility. Does flexibility mean great? Maybe not, just depending on whatever it is that you're trying to accomplish. So where Darius is talking about whole life, we have guaranteed consistent rates of return within the cash value and the death benefit. That's not the case over here in Universal Land because of the flexible premiums. It affects the cash value, it affects the death benefit. And the other thing too, keep in mind is with Universal Life is the cost of insurance can go up the older that you get because of the fact that the premiums aren't level. So that's that in a nutshell.
So when it comes to whole life insurance and universal life insurance, what we should really focus on, the meat and potatoes, is the money. So let's say you fund your insurance policies for several years. When you pass away, or let's say the cash value, it should be more than what you put in. It should provide a benefit financially for you and your family.
Very good point.
So let's say in 8 to 10 years, with a whole life insurance policy, a mutual whole life insurance policy, you have all the cash value that you put in your premium. So if I put in $100,000 in my insurance, my whole life insurance policy, I have $100,000 that I can use for my cash value, and I have the death benefit of whatever it is, $600,000 for us in our case. No, we have about $1 million on ours in 10 years. So really think about that. In some universal insurance policies, the guarantee on the guarantee side, always look at the guarantee side, because if you fund your policy and you put in $150,000, but your death benefit is only $100,000, that doesn't really make any sense. No. They can tell you that you're going to get this rate of return all you want to, but let's really consider the guarantees.
Totally great point. I'm so glad that you mentioned that, because we find that so many people bring universal policies to us. Hey, can you evaluate this policy? Can you take a look at it? But what we really want you to see, like Darius said, just to reiterate, look at how much you're contributing on an annual basis over a 10, 20-year span, and then watch the death benefit and the cash value growth. Because what we tend to see with universal life policies is that you're overpaying for insurance, meaning that your premiums end up exceeding whatever your death benefit value is, and way exceeds the cash value availability that you have. So those are things that you need to keep in mind when it comes to insurance. So if we compare these one to one, they are both permanent insurance, they both provide cash value, they both provide death benefit. One provides a consistent rate of return, whereas the other has more flexibility. And maybe flexibility might be good for you, but you just need to understand what that flexibility does to the growth of the policy.
Right.
That's that. Hope that was helpful. There is so much more that we can talk about universal life, to be honest, but we just want to make sure that you understand the basics. So universal life provides flexibility. If you like flexibility, good for you. We prefer a consistent rate of return, which is why we do whole life insurance all day long.
From a mutual insurance company.
Mutual insurance company, so we can get the dividends.
Right.
But yeah, you guys, thank you so much for tuning in.
Well, since you mentioned dividends, let us tell you what dividends are.
I was signing us off.
So, as the insurance company profits, or after they pay all of their overhead, there's money that's left over, which goes out to the insurance, the policy owners, the policy owners in the form of a dividend. So that's what a dividend is. After the insurance company pays all their bills, the light bill, the water bill, everything's paid. The profits that are left over are shared with the policy owners in the form of a dividend.
Correct. And now you bring up something else that I want to mention. Darius was talking about the riders. I realized I didn't talk about riders with Universal Life. And just to reiterate, riders are additional features or benefits, whatever you want to call it, that you can add onto your policies at the time of your contract. So you can also add riders onto Universal Life as well. And there's a plethora of riders out there for you. You just got to know which ones that you want.
Yeah.
So that's that. Anything else?
Nope. I just hope you had as much fun talking about insurance insurance policies as we did.
All right, guys. Be sure to subscribe to our YouTube page and also follow us on at wealthnation.io on Facebook and YouTube. We are just unraveling today. I hope you guys have a great day and own your own lifestyle.
Or someone else will.